Total household wealth in the United States currently sits at an all-time high of $150 trillion. Record corporate profits and high-performing stock markets suggest a period of historic economic strength. Yet, on the ground, that abundance vanishes. A staggering number of Americans earning six-figure salaries report they are stretched to the limit, living paycheck to paycheck. The basic milestones of the American dream have shifted. Groceries, utilities, and starter homes, once standard expectations, now function as high-end luxury goods. This disconnect stems from an economic engine redesigned to reward asset owners while quietly eroding the purchasing power of wage earners. On a Sunday evening in August 1971, President Richard Nixon officially suspended the gold standard. Every dollar was previously anchored to physical metal sitting in a vault. Once that link broke, the dollar became a fiat currency, a unit of exchange backed by a government promise and subject to infinite expansion.
For 30 years after World War II, worker productivity and hourly compensation grew in lockstep. As workers became more efficient, their pay rose accordingly. After 1971, that relationship fractured. Productivity soared, but real hourly compensation completely flattened. The workforce generates more wealth than ever. The system simply ensures they no longer keep it. Monitoring this loss of purchasing power falls to the Bureau of Labor Statistics, the agency that calculates the Consumer Price Index, or CPI. In the 1980s, economists changed how they measure inflation, introducing mathematical adjustments like substitution. If the price of steak rises too high, the formula assumes consumers will switch to cheaper ground beef. By swapping the item in the calculation, the official inflation rate stays low, hiding the actual rise in the cost of living. The official index stopped measuring a middle-class standard of living, becoming a metric for basic survival. The flow of this newly printed wealth follows a 250-year-old economic concept known to the financial elite as the Cantillon effect. New money enters the economy through central banks and elite financial institutions first. These institutions use that capital to buy hard assets before the rest of the market's prices can react to the expanded money supply. Today, this plays out in the housing market. Private equity firms use low-cost capital to outbid families for single-family starter homes. All cash, no contingency offers convert traditional home ownership into a permanent corporate rental model. Inflation acts as a regressive tax, redistributing wealth from the wage earner who gets the money last to the asset holder who gets it first. Advanced AI and hyper-automation threaten to expand this wealth gap. Historically, corporate growth required human managers and analysts, circulating profits back into society through salaries. Modern tech companies use AI to generate millions in revenue while bypassing human labor. This creates a world split between those who own automated systems and those whose labor has lost its market value. Income derived solely from a paycheck follows a rigged mathematical path. A standard salary rarely outpaces inflation, while the nominal value of stocks and real estate grows at double digits. Traditional savings strategies fail when the currency is designed to lose value over time. Staying ahead requires a shift from trading time for cash to acquiring productive assets. The feeling of falling behind is a rational response to an economy where the rules shifted while the workforce was busy.